Okay, my name is Eric Rosen, and I'm really excited to be with everyone today. Welcome to the Macro Trends Quarterly Update, and I have the privilege of being with Alicia Levine and Peter Boockvar, who joined us last time for a very highly regarded review that got amazing feedback. So we're back at it again. So I just want to start with a quick note about 3i. I'm in Miami right now because I have a dinner, and I use the power of the 3i network to get somebody's office from 3i, my friend John Brecker, who's going to dinner with me. And I'm using his office, so I'm not in my normal place. But the 3i network is a huge, powerful one. And if you take advantage of it and use your friends on the 3i network, they can always help you last minute. So think about that. As a reminder, if you have questions, chat them to me, and I will integrate as many as I humanly possibly can into today's presentation. So with that, Peter and Alicia, thanks for being here.
Thanks, Eric.
My pleasure. Okay, so Alicia, let's start with you. We had a massive outperformance in stocks in 2023. What in the heck did everybody get wrong?
Well, we had a massive outperformance in stocks, but it was mostly located in the top 10 stocks of the S&P, the large cap mega tech stocks, which really drove 80% of the returns last year. And, you know, the big trend that everyone got wrong is that there was no recession. And so what's interesting about those large cap tech stocks is they work when everybody was worried about a recession, and they worked when everybody was not worried about a recession. So that's really what you know, the prognosticators got wrong. The trend was wrong, number one. And number two, even though large cap tech is historically exposed to the rate cycle, they were looked at as safety stocks because of their cash flow. Put it all together, and they drove 80% of the S&P return last year.
Are you worried about 29% of the S&P market cap being in these 7 large companies? I mean, it's even higher than the dot-com bubble. And if you look at a few short years ago, it was 14 or 15%. Are you concerned about that?
I'm concerned to the extent that earnings don't keep up with it. As long as the earnings of those top 10 stocks are about 29 to 30%, then we're okay. I mean, the margins are better in those stocks. The revenue growth is better in those stocks. And so the multiple is also higher in those stocks. So the concentration risk is real, but the performance is better also. So I don't think they're as expensive, or I don't think the S&P is as risky as other points in time when you had huge overweights.
Okay, Peter, what about you? What do you think about what drove the amazing returns from last year?
Well, it was consumer spending that held up much better than expected, even though it was very bifurcated, mostly concentrated on the upper end. And you had an extraordinary amount of government spending that also helped the economy, and also a lot of the government programs that induced a lot of manufacturing building and facility construction and so on. And I think when you appreciate that the Fed raised interest rates so much in such a short period of time, the belief that it would have an immediate impact. And I think what we're learning is that the lag of higher interest rates takes more time to seep its way into more parts of the economy. And certainly New York Community Bank reminded us that commercial real estate is still a problem. And every day somebody's loan is coming due, that's going to get negatively impacted by that. So I think that's the main reason. But if you take a step back, you look at globally, you know, Europe is essentially not growing. China is obviously slowing down. So it's a very mixed picture globally.
Okay, I want to ask you one follow-up question on that. And as you touched on the U.S. consumer, I would say if I got anything very wrong last year, it was the U.S. consumer, and betting against them proved to be a bad idea. Your view, are we starting to see more cracks in U.S. consumer, or are still pretty strong?
Well, the low-end consumer is feeling their own recession. I think that's clear, and we've heard that from a variety of retailers. Just last week, company Monroe, which sells tires, talking about where before someone would come in and replace all 4 tires, and then they're now replacing 2, and now they're only down to replacing 1. And then the upper-end consumer, again, is spending. They're generating interest income with 5% interest rates, they're traveling, and so on. So there's a 2-lane highway here when it comes to the U.S. consumer. It's not the consumer is great. It's some are doing well and some are not.
Right. Okay, thanks for clarifying. All right, Alicia, back to you. Where do corporate earnings go from here? You touched on the strength of the big Magnificent Seven corporate earnings. What about in general? What are you anticipating for 2024 corporate earnings?
So, the market, Wall Street is at about 11% earnings growth for 2024. We're actually at about 8% earnings growth because we just think that there are some sectors that are still exposed to the higher rates here. But even with that, you can still have a pretty positive year. Thus far, I'd say the financial sector, aside from a couple of small community banks, have held up okay despite fears of what's happening with bank balance sheets and the funding model. So we've had most of those banks report, so they've been okay. I'd say on the tech side, it's been good enough. We just heard from Amazon tonight. I didn't hear Apple because we were logging in, but that looked good. Meta looked terrific. So, the earnings story is fine. And if mega cap can earn, then you're gonna hold up the earnings picture for 2024. I'm not sure you get to 12% earnings growth, but you can certainly get to 8 or 9% with a good enough economy.
All right, Peter, what about you?
Well, what's interesting here is that it's just a strange market where these big cap tech stocks continue to generate earnings or are getting rewarded. But we have to keep in mind, who are their customers? The customer of Apple is the average consumer. The customer of Meta and Google are business, and a lot of that small and medium-sized businesses. So Microsoft, they sell hardware and software services to a lot of businesses. So you have those stocks doing great, but no one cares about everybody else. But if one is the customer of the other, you wonder how sustainable that is. And we're stretching this rubber band to such a great extent that, again, you can't have the sellers of product doing great and the buyers of product more challenged. There's got to be some sort of reconciliation at some point.
Okay. And so, Peter, what are you calling for returns for, let's just say, S&P and NASDAQ in 2024?
Luckily, I'm out of the game of throwing out price targets. I just don't know. I think that, as I said earlier, we still have a lot more time for the higher interest rate environment to flow through the broader economy. So I still think that, at least in commercial real estate and other parts, there's more pain. There's an enormous amount of debt that needs to be refinanced in the coming years. So I think that with valuations where they are, the market just betting that the Fed's going to bail everybody out and aggressively cut interest rates, I'm not so sure. I think with respect to inflation, it's going to moderate this year on the service side, but could it reaccelerate on the good side? So it's a very complicated picture, and I'm actually more confused now than I've been in a while.
Okay. Alicia, are you making any calls for 2024? And with respect to levels for S&P and maybe NASDAQ?
We have. I mean, our estimates include a 30% chance of recession just because the long and variable lags on the rate cycle are not quite done yet, in our opinion. There is going to be some blowback from commercial real estate. The lower end consumer is stretched, is using credit to spend and to fund lifestyle and to fund purchases. And as we know, those have APRs of 20% now. It's really extraordinary. So there'll be some pain in parts of the economy. So that's a long way of saying that, our target for the S&P for the end of the year is between 5,000 and 5,100. But if there's no recession, that clearly goes higher to 52 to 5,400 on the S&P. And it's about getting the trends right. It's getting it right. If there's no recession, then we can do much better. I just think that I think the inflation picture is definitely more confusing, as Peter says, than it was a month ago. I think what's happening in the Red Sea, besides being a geopolitical risk, is also an inflation risk. And so that just gets very complicated because all the disinflation, for the most part, yes, it's been driven by some decline in inflation in the services sector, but it's essentially been driven by the decline in oil prices and the disinflation in the goods sector. And so the goods sector is pretty much, and the inflation rate is at 0%, and sometimes it's in deflation in some months. If that changes, because containers are now, I don't know, $10,000 to ship anything because of the clogging up of the Red Sea and the avoiding of the Red Sea, then you start getting inflation again in the goods sector, your CPI is going to start moving higher. So it is confusing. It is less clear.
And you also mentioned, and Peter did as well, about the lower end consumer. I was reading, obviously credit card debt is at all-time highs, over $1 trillion. At average rate is 22 or 23%, but they're now using buy now, pay later more because they're tapped out on their credit cards, which I'm always been a believer. If you can't afford it, don't buy it. And people are out there buying their Uggs with buy now, pay later, which drives me absolutely bonkers. Okay, Alicia, back to you. The market is pricing in 5 or 6 rate cuts for a total of 150 basis points. Where do you think that shakes out? Is that too aggressive in light of some of the concerns you just articulated about potential shipping impact and inflation?
So I think the 5 to 6 cuts feels excessive right here. That essentially means you're getting towards an economy that's on the verge of recession, if not in recession. I mean, then you can get 6 to 9 cuts, right? Because in a real downturn, the Fed would cut more and more quickly. But, for the most part, we're at 3 to 4 cuts for this year because we think in an election year when the government is spending money to keep the economy afloat, you're just going to have a better economy. And so the Fed will cut maybe 3 times, maybe 4 at the outset. It's really about the real rate, right? If inflation's at 3% and your Fed funds rate is 5.25, then the Fed wants the real rate somewhere between, let's call it 1.5 and 2%. And so if they do nothing and inflation keeps falling, then your real rate is rising. So they'll cut. I'm not sure March is off the table, to be honest with you. I know that's what Powell said yesterday. The market sort of convulsed on that. But I think that, definitely the spring. So if not March, then May. And then the biggie here is what happens with QT. Because if they start to curtail QT, if they start tapering QT, then that's wildly bullish for risk assets.
Okay, Peter, how do you think it's going to shake out with rate cuts and QT?
I think Powell is going to wait till the very last minute to cut interest rates, and I think he's really going to be more responding to weakness in the economy and only wanting to cut a few times. I mean, his worst nightmare is to see a reacceleration on inflation. QT is sort of being forced upon them to taper it because of the reduction in the reverse repo facility. But up until this point, the shrinkage in the Fed's balance sheet has been offset by money coming into the Treasury market via that facility. So if the facility goes to zero, if the Fed tapers QT, that's great. But then if that's because the RRP's basically back to zero, then there's no real new liquidity thing. And the Fed will still be stuck with a massive balance sheet, which is not what they want. They don't want to have such a big balance sheet. I mean, since January, or I should say first quarter 2020, so right before pre-COVID, I mean, nominal GDP is up a fraction of the increase in the Fed's balance sheet. So yeah, it'll be nice for the Fed to taper it, but I think they're going to be very reluctant to cut short-term interest rates. And I think we have a scenario that they can cut short-term interest rates and long-term interest rates actually go up, because that would show that they're backing off from their inflation fight. And I think the U.S. Treasury market still has a lot of issues with respect to excessive supply and maybe not enough buyers, and that we are not done with this bond bear market.
That's interesting. So if the market's suggesting 5 or 6, are you at 2 or 3? Is that where you shake out?
Yes, and I think the Fed's going to be reluctant, even though they'll say they're not political, to cut ahead of the election. And if they do go 6, it's because we're in a recession. So is that something to celebrate? I'm not sure.
Yeah, I mean, I think we might have another chart up here later, but when you think about how poorly the Fed and the Treasury handled this, with really the Treasury not terming out their debt a few years ago or 2 years ago when interest rates were zero, basically every S&P 500 large cap company termed out their rates and locked in low rates, and they're locked in bond rates at very low levels. And what do we have, Peter? I think you said $17 trillion of debt coming due over the next couple of years. Is that right?
Yeah, there's like 9 coming due this year. But even with that, Yellen's still not interested in terming out because she doesn't want to see a rise in long-term interest rates ahead of the election. So she's still front-loading treasuries and sort of manipulating the yield curve and, in a way, doing the job of Jay Powell.
Interesting. Okay, let's move on to oil. Alicia, this question's for you. We had a very volatile 2023 in oil. Sold off, rallied, sold off again, and now with more conflict in the Middle East, people are calling again for potentially $150 oil. Where is it headed? Where do we go from here?
Yeah, look, I mean, the headlines alone suggest that oil should be at $100 a barrel, and it's not, because the headlines are dreadful. So the question is, why is it? Why is the spot price not responding to the area which has the most geopolitical risk? And there's two answers. The first is that the U.S. is actually pumping more oil and gas than it ever has, more than 2019 under the Trump administration, at over 13 million barrels a day. And that is helping to supply the market in the U.S., keeping WTI down. And so it can't do it forever. If there's a hot war with Iran, oil will go higher, but it can help with the skirmishes and the low-level conflict, as in low level for the countries that export oil. And so that's part of it. The other is that China growth is terrible, and the growth is worse than expected. I think it's safe to say that some of the statistics and the growth statistics are manipulated, because the country's in deflation with cratering domestic demand. And so, Brent tends to be correlated with China growth. And I think that Brent being where it is suggesting that Chinese growth is going to be worse than expected this year. If that turns around, then you can see oil prices much higher. But it's not just the geopolitical thing and the U.S. pumping more. It's also the decline in the growth rate of China.
I don't think the U.S. can pump more for very much longer. They're using, formerly drilled and uncompleted wells, so they're not drilling a lot of new wells. So that is a short term. That's short term. It's not a long term solution. So Peter, do you want to chime in on this?
It's an electoral decision by the administration. There's no accident that it's happening now. 23 into 24.
Yeah, I mean, the rig count has continues to go down. So the level of U.S. production is just completely unsustainable. So I don't expect that to continue. And with respect to global demand, China demand has been okay, but look at India and other parts of the emerging world. I mean, their appetite for crude oil is only going higher, and that's why oil demand is going to grow for decades to come because of these emerging markets. So I think that is going to be a persistent sort of driver of and put a floor under oil prices. And yeah, it is surprising that there hasn't been any sort of geopolitical bid to the price of oil, but I still expect the surprise with oil prices not to be on the downside, but to the upside.
I would agree with that. I would agree with that. There's risks to the upside.
When oil was hit 92 or 94 late last year, I thought it was going to 100, and then it came back down. I mean, I think a lot of what you both said is very interesting. We'll see how that plays out. And, we've seen a lot of noise around EVs and a slowdown in EV sales, and a lot of people having problems charging their car in the cold, not keeping a charge in the cold. Tesla downwardly revised their forecast. Part of that is China with respect to new entrants from China. But part of that is without significant subsidies, EVs are very hard and they're not for everybody. We have a Tesla for 6 years, but I can't get a second one because the charging issues and the range. But I think it's going to be very interesting. I'm of the view that oil demand is going to go up for decades. Some think it's going to peak in 2030. I am not of that camp. I think it might be 2050 before we see a peak in oil demand. And what are we, 102 million barrels a day, something like that, globally. And I think that trend is going to continue to the upside.
And it's hybrid that people want now. They don't want EVs. They want hybrids.
Listen, I agree. In Florida, you can't really have only EVs because if you have to leave with a hurricane, you can't get out of harm's way. So you always have to have a ICE vehicle to get the heck out of there, because we've had to drive out of there a couple times. Okay, Peter, on to Bitcoin versus gold. We saw Bitcoin, I think, was up 160% last year, and it was really one of the best performing assets. And I have the 5-year gold chart up as well. Do you like Bitcoin or gold at these levels, and why?
Well, I do think that people that are bullish on Bitcoin are sort of soulmates with those that are bullish on gold. A relatively finite asset with limited supply and that can't be printed by central banks. So I prefer to play through gold. I don't disparage Bitcoin because but I leave that to others to make that decision. I just prefer gold. But I still think that there's a underlying theme that accounts for the bullishness on both. I just prefer to express it in a different way than the Bitcoin lovers out there.
So where do you think gold could go? I think it's around 2,000 today. Where can it go?
Well, if you inflation adjust gold for its 1980 high, you're talking 3,200. If you sort of match it up as a monetary asset with an increase in central bank balance sheets over the past 15 years, you can make the argument that it goes to 5,000 or 10,000. I'm just saying 3,000 is where it can easily go. And silver
in 2024 over the next 11 months.
I've done a really bad job of trying to figure out the pricing on that. But if you look at how well gold is traded over the last couple of years in the face of a very sharp rise in real interest rates and strength in the dollar, that tells you a lot that there's a major bid underneath gold. And that bid is coming from central banks who were buying gold hand over fist and at record levels. So now if you get a tailwind of Fed rate cuts and the softening dollar, that can really create a tailwind for both gold and silver.
So for the benefit of some of the viewers that may not understand why you just said what you said and the impact on rates and gold, because gold does not have yield. So can you just explain that for everybody so they could follow along?
Well, since gold doesn't pay you an interest rate, it sort of competes against inflation-adjusted interest rates. When rates are at zero, the cost of owning gold is basically nothing because you're not getting anything in fixed income as a comparison. But when interest rates go up, particularly relative to inflation, well, that can create greater competition. And that gold did not sell off in the face of that competition, so to speak, tells you a lot that there's a great demand for gold out there, particularly in the Eastern world. And that demand for gold definitely was facilitated when the US and the EU decided to confiscate half of Russia's central bank reserves, which encouraged other central banks around the world to not have as many US dollar assets, and they felt more comfortable owning gold in their own vaults on their own land.
Okay, great. Alicia, do you have any thoughts on gold versus Bitcoin?
I just think what he said is really smart. I thought the point about sanctioning the Russian central bank, you get to do that once. And so they did it, and it has effects, and it didn't work. Number one, for Russia, and number two, it did create effects here. I think that for Bitcoin, we don't recommend it for our clients because we can't value it. But I see it as a speculative asset, and there's always, if you want to speculate, that's fine. But there's no way to value it. It's not a unit of trade. It's not a unit of exchange. So to that extent, it's essentially betting that someone else is going to buy it higher from you. So.
Yeah, I have a very small allocation, but I'm glad I do. So let's talk about commercial real estate, and it's timely and topical in light of the news yesterday, a 40% sell-off in a bank shares stock, citing commercial real estate, community bank share stock. So where are we going to shake out in 2024? Are we going to see a sharp uptick in defaults, and what are the ramifications? Peter, why don't you tackle that one first?
I think it's going to be another mess this year with about $500 billion of commercial real estate debt maturing. And you want to talk about a rate shock spillover. It's in commercial real estate, with that obviously being the most interest rate sensitive. And when you're talking about an interest rate going from 3%, call it, that was financed pre-2022, now with the cost of capital being 8, 10, even 12%, those are just not economics that can survive if a lot more equity is not put into a deal. So yes, with office, you have the structural challenge, but with any piece of real estate, regardless of where it is, if you have an offsides balance sheet, you're going to get hurt. You may have a 90% occupied multifamily apartment, but like I said, if your interest rate is going from 3 to 8, you're not going to survive. And there's a lot of, and this chart shows, at least on the corporate debt side, just how much debt still needs to adjust to this higher rate environment. That's why this challenge in this new rate world we're in isn't just going to go away, and it's not going to be solved by 100 or 150 basis point rate cuts by the Fed. There are years of adjustments to be had here, and certainly commercial real estate, being the topic here, is going to be the most hurt. And even if interest rates just stay where they are, it's going to ensnare everybody, or I should say any real estate person, every day that they have debt coming due. So there's a lot of pain to be had here, a lot of challenges for banks that have extended this debt and loans, and a lot of the holders of real estate that just can't come up with equity. And a lot of real estate that was priced pre-2022 and the years before that, these were interest-only loans. Like no principal has been paid back over the last couple of years. So a lot of distress to be had here.
I think you brought up a couple points, and I think a lot of folks feel that it might just be the office market that's under pressure. I've got a lot of examples of apartments being given back to the banks because of something you said. They were paying 3%, now it's 8%, and they were getting an 80% loan to value. Now the bank's only giving a 65% loan to value, and they can't get their fixed charge coverage. So for a host of reasons, even though they're still 95 or 97% occupied, there's very low vacancies and rents have gone up. The cap rate move, the interest rate move, and the bank pullback is weighing heavily on not only office, but also apartment buildings. So, Alicia, what do you think about commercial real estate for 2024, and what's the impact? And maybe we can also talk about the impact on regional banks in light of what just happened yesterday.
Yeah, no, just to reiterate what you said, Eric, we have clients who are developers down here in South Florida who are essentially telling us the same thing, that their properties across the country are seeing some distress in multifamily. So it's $1.5 trillion if you go out to the end of 2025 that has to get refinanced, including multifamily as well as office. And so that whole sector is looking to be repriced by a huge haircut. As it relates to small and medium-sized bank, I think what we saw out of New York Community Bank yesterday, specifically citing commercial real estate, I think that's just going to be one of many. So as we know, the large money center banks, because of all the regulatory structure after the global financial crisis, have not been allowed to hold as much commercial real estate on their balance sheet as a large percentage of their assets. That left the smaller and mid-sized banks that were not as regulated to essentially own that lending market, which they did. And because that was not the same regulatory problem. And as a result, you've got certain banks that are heavily concentrated to commercial real estate coming due in the next few years. What does that all mean? I think you're going to see M&A in some of these smaller banks nationally. I think the Fed knows that. I think they accept the rate cycle. They accept the risk to the smaller banks as the price to pay for getting rates where they needed rates to get, because once Congress comes in and adds a regulatory structure over those 100 billion and 250 billion asset banks, their models don't work, their funding models don't work, and their balance sheets don't work. So
you think they're going to let a couple banks go? You're going to see some banks.
They're definitely going to let a couple banks go. It's not going to be, 2008 by far, because we've seen how they're going to contain it. So depositors will be made whole. We saw that from the FDIC, and we saw that the Fed's going to clean up what they need to clean up. So are there going to be moments of tremors? Probably. I mean, there's some reverberations just from yesterday's announcement from New York Community Bank, but it's not the only one. I think this you have to think of as the cockroach theory, right? If there's one, there's more, because it was a structural issue that put so much commercial real estate on those balance sheets, and the structural issue has not changed.
Good points. Okay. So Peter, why don't we talk about geopolitical risks? Obviously, the Middle East is a hotbed, and we've actually had 3 U.S. troops get killed in the last week and a couple dozen injured. And I just saw a headline before we went on that I don't know why they announced it, but they're going to do something to Iran. I don't know why you'd tell the world that you're doing that. Just do it and not tell everybody. A little element of surprise in war. Call me crazy.
So I was doing the same thing when I saw that headline.
I was like, why would you tell them? Why are you telling them this? But okay, that's why clearly I'm not a 5-star general in the Marines or Army. So with respect to geopolitical risk, what do you think the impacts are going to be on the market? And whether we touched a little bit on oil, but really on the stock markets, what do you think?
So markets really don't respond to geopolitical events and risks until there is an actual movement in the price of oil or disruptions somewhere. And at least oil has been contained because there has been no disruptions in the supply of oil. But as we've seen in the Red Sea, there's been a major diversion and disruption in the shipment of goods. And as this chart shows, the World Container Index measure of a 40-foot container from Shanghai to Rotterdam, it's spiked. Now, granted, it's well off its peak of 2021, but you can see it's up about 200% from where it was just a month ago. It actually, today there was an updated number, it softened it a little bit, but it's still up a lot. And so we're talking about not only a delay in getting your stuff by 10 days to 2 weeks, but it's costing you a lot more. And this is the stuff of an increase, a reemergence in inflation. Now, Alicia mentioned and made the great point that goods prices are back to zero. And just for context, in the 20 years leading into COVID, core goods prices averaged zero. So when we talk about inflation, services inflation is never transitory. It's always a straight line higher. It's always the good side that benefits from efficiencies and productivity and technology and so on. So you have the possibility of a reacceleration in goods prices. And in fact, the ISM services number today saw an increase in prices paid, and the S&P Global manufacturing number saw a reacceleration in the prices of goods. So that is a major consequence of the geopolitics that we have to keep our eye on. But again, generally speaking, geopolitical stuff only has a fleeting impact on markets unless it directly affects commerce.
Okay, Alicia, what do you think?
Look, war is inflationary, and it's clear that if the goods sector is under stress because of a global shipping, then we're going to start seeing more inflation in that sector, and that's going to be very difficult. But it's not just the goods sector. I mean, on the geopolitical side, war itself and rearming is inflationary. So, and it winds its way through markets because of supply chain shocks, whether it's food or whether it's energy or whether it's commerce. So I think we're not quite done here. I'd say that there's been some really inartful managing of risk. I'll just put it that way. In the last few years, not relying on deterrence, but relying on, well, we'll come get you if you get us first. And I think the U.S. is in a difficult spot here with how to respond to this without making things much more difficult. So our big risk for the year really is geopolitical. And as Peter says, it almost never matters to markets. Almost never. It's fleeting. It's almost as if it's a natural disaster and then it's over in a few days. This is one of those years where it could drive the inflation that has been falling. So the one thing that's out there.
All these things that you guys have outlined, so definitely suggest that 5 or 6 rate cuts is probably not likely in light of a lot of things. But I agree 100% with what Peter said 10 minutes ago about Powell really not wanting to see a problem like we saw, a few decades ago where inflation spiked again. So we have a question from the audience. Chuck, with rates potentially still falling and the fact that small and mid caps have not gone up as much as the big 7 and so much money in PE funds that are nearing their 3rd or 4th year of call down, which SMID to potentially benefit the most? So I think NASDAQ was up like 40%, S&P up like 25%, and the Russell was up maybe 16 or 17%. So a big underperformance by the small caps. So with that, Peter, how do you answer that question? Which index do you like to perform in light of what happened over the last 12 months?
Well, speaking with the bias and through the lens of being more of a value investor, I want other parts of the market to catch up. I mentioned earlier that, how can the big names do so well and all of their customers not do so well? So I do believe that the gap between the expensive stuff and the cheap stuff is just so extreme, and the love affair and the cult following of these big stocks is so extreme relative to everything else that it's just not sustainable. Now, of course, you could have said that many times over the last couple of years, but I think we're reaching just such extremities that I just don't see how it's sustainable. Again, who's Facebook's customers? They're small, medium-sized businesses who want to advertise their goods and services. And if they're going to suffer well, they're not going to spend the same amount. If they're going to do well, their stock should get rewarded here. So I'm hopeful that there is some closure of this wide gap in valuations.
Okay, Alicia, what do you think?
So I would like to think that small caps can do well this year because the S&P is at new highs, NASDAQ is at new highs, and the Russell is 20% below all-time highs. And so that feels like a spread that should be closed. But the problem with the Russell is that it's heavily weighted to the small and regional size banks. So that's the problem with that index. And so it really has to be something a little bit more artful than just buying the index. The other thing is, if you look at the first month of 2024, when everybody was really excited about rate cuts and, they're going to cut in March and inflation's going down, it's going to be great. The Russell actually underperformed the S&P by 5%, even in a world where the market was still pricing in a March rate cut. So now that the market's pricing out that March rate cut, it's hard for me to see how the Russell performs here, but I think that's a short-term issue. If you get the glide path, there will be more spending from Washington this year in an election year. We'll talk about that later. And you kind of support the economy here, then you should get some bounce back in the small and mid cap sectors. It really has been a one-trick pony for the last year. But let me say this, in the last 15 years, there's only 1 year where growth did not lead, and that was in 2022. Otherwise, the other 14 years, growth led, as Peter knows.
Okay, so that's a good segue into the possibility of an echo inflation bump. So, Peter, why don't you explain to the audience what exactly an echo inflation bump is? And we have a good chart. Hopefully people can see it on the screens. Explain what it is and why you're fearful of it.
So yeah, this is a chart of the late 60s into the late 70s, very early 80s. And you can see how we've had these periods of acceleration of inflation, a deceleration, and then a reacceleration. And on the deceleration, the Fed backed off from their inflation fight, which then helped to stoke inflation. And a couple of things we have to keep in mind is we talked about the potential for a reacceleration in goods prices, but I expect a further deceleration on the service side because of a slowdown in rent growth. But we have to keep in mind that tight monetary policy doesn't just impact the demand side, it also limits the supply side. So rental growth is going to decelerate further, to give an example, in 2024 and into 2025. But after a record number of multifamily units coming online this year, there's no new construction that's getting started in multifamily. So you're going to see a reacceleration in 2025, late 2025 into 2026 in rental growth. And that's because a high cost of capital is also limiting the supply side of the economy, just as easy money encourages the supply side of the economy. So now that we're seeing a deceleration of inflation, tight money is sowing the seeds for an eventual reacceleration of inflation. And this is not an experience that Powell wants to experience. And we have to understand that having inflation spike and then come down, and the come down is not winning the war, it's just winning a battle. It's keeping inflation down for a sustainable period of time is what wins the war on inflation. And you'll hear the word, and we've heard the word a lot, sustainable, from a variety of central bankers, and not just in the US, but we heard it from the Bank of England today in their statement. A sustainable fall in inflation is what they're looking for, because they don't want to see the reacceleration, because that would be both an embarrassment and a problem in addressing.
Yet another reason that we probably don't see 5 or 6 rate cuts in 2024. Alicia, what do you think?
I think that, the data show that when inflation gets to be over 6%, you've almost always had an echo bump, not just the US, globally, and all the data show you that. And so, look, we are not at 6 rate cuts. We think that really is only reflecting a severe downturn in the economy. And if that's the case, it's more like 9. And again, there are places where you can see this inflation bump coming from. The goods sector is one, wages is another. And so it's a possibility. I just think that the Fed is going to lock itself in here, because on the election year, if it's going to cut I think the Fed will try to do it not around November. If it starts cutting early, it's tapering QT, you get into a situation where risk assets rally again, and you could be faced with it again. You can be faced with inflation again.
Interesting. Yeah, I know, Peter, something you said about tightening on lending and tightening lenders that are what's happening. I speak, a lot of my friends are real estate developers, and they have said that financially it doesn't make sense to do lower cost apartments given the cost of construction, the cost of borrowing. You have to do more luxury. And as you said, there's a lot of units coming online over the next 12 months or so, 18 months. And then it's going to really hit a wall because people who started a project, 18 months ago are okay if they locked in some lower rate financing, but if they didn't, it's really hard to justify. Okay, Alicia, let's start on this one. It's really hard to trust data out of China, as we all know, and we've said a lot of comments about this in the past, but it has definitely been slowing. You look at what the stock markets are doing there. What do you make of the impact of the slowdown, high youth unemployment levels? They actually started quoting them again after a long period of time. They took them off. They were getting so high, they stopped quoting them. So in China, when data gets bad, you just stop telling everybody about it. And then we obviously saw a real estate market, Evergrande liquidating. So there's a lot to digest out of China. What do you make of it? And what do you make of the global impact on that?
So I think that overall, you can see by the chart, the orange line there, China is about 23. It was as high as 25% of global GDP growth, since the year 2000. That's rolling over here because they have population problems. I mean, their population is actually shrinking. They've got domestic demand problems, and they've got deflation. And deflation is really the killer for economies because consumers sit on their hands expecting prices to be lower tomorrow than they are today. And so you just get into a situation where it's very hard to grow the economy, particularly if you want to stimulate domestic demand. Now, the other thing that we know is that the U.S. has larger trading partners in Canada and Mexico than it does in China. For the first time in a couple of decades. And so if you look at China's trade partners coupled with the problem of domestic demand, you're just going to grow slower. So global growth looks to be slower, and you can just see it slowly rolling over. It kind of peaked in 2021 when China recovered faster out of COVID than any other economy because they locked everybody down. It looked like they had no spread. And then, they've got 2,000 people in a swimming pool and taking pictures of it. Well, we were all locked down in the Northeast. But, that was not sustainable. So look, demand will be less from China. The reshoring of supply chains to friendlier nations is real, moving growth away from there as well. And I think they have like they got a multi-strategy problem, and it doesn't help that the government does not seem completely committed to the private sector. It's on a different path.
Peter, what do you think?
So it's a very nuanced situation with China. Is they have to be the biggest challenge right now in China is, yes, I agree that the sort of disrespect for the private sector is not helpful. Interestingly enough, 85% of the people that work for a company in China work for a private company. So they're actually a mostly private enterprise economy, even though you would think otherwise. The biggest challenge they have right now is the real estate market. With respect to manufacturing in China, they're experiencing a recession like all manufacturers are around the world. But China is still a manufacturing powerhouse. And over time, they need the US much less because there is this massive middle class that is exploding in size in Asia over the next 10 years. I mean, even China's middle class is going to double over the next 5 years. It's growing hugely in India, in Vietnam, in Thailand, Indonesia. Those are all future Chinese manufacturing customers. And now China is having the ability to transact in currencies outside of the US dollar, whether it's buying soybeans from Brazil or buying oil from Iran and Saudi Arabia. There is some non-dollar usage of currencies. And with respect to the Chinese consumer, it's bifurcated there too. You look at the Macau numbers, gross gaming revenue is back to where it was in 2019. Domestic travel in China is above where it was in 2019. So I think that there is a very sort of mixed picture overall in the Chinese economy, even though in the aggregate, yes, growth is slowing. But if they can sort of put a floor under their residential real estate market, I do think that you can get a floor in their broader economy, in the next year or two, which would help the global recovery. And if there's a restocking that takes place with respect to goods and inventories, well, China's manufacturing sector is going to recover just as ours is and just as Europe is.
Interesting. I read an article that suggested that the number of homes built in China would account for more than double the population. So I know there's 1.4 billion people in China. I don't know how many families are in China with all their single child laws, but the estimation was there was 2 times the number of homes built than the market could absorb. So, with that, I would think that it's got a little ways to go. Great question from Deval, and that is views on India, which is growing at a good rate, contrasting with China, relatively young population, still lags on a per capita GDP basis, but views on future growth potential. Any recommendations on how best to invest in India? I don't know, Alicia, let's start with you. We want Peter to take that?
Yeah, let Peter take that one.
Okay, Peter, go ahead.
So I think India is probably the most exciting emerging market story in the world for the reasons just stated. And I think Modi has been a key catalyst for this economy and the growth rate it's seeing. The enormous amount of infrastructure spend that is going on in India, they're essentially replacing China as the incremental buyer for a lot of different things, even though China still has a voracious appetite for things. We've been long the India ETF, INDA, for probably almost 6 years now as a play on this, and got bullish when Modi was elected. So I'd rather.
How did it perform last year? What did it do last year? Do you remember? How did that ETF do last year?
It's done well for the last 5 or 6 years, but the market's not cheap anymore. I mean, it's an expensive market trading at like low 20 multiple. So it's not like this is.
You're paying for the growth.
What's that?
You're paying for the growth.
Yes, it is. So it's not necessarily an undiscovered idea, but it certainly is a very exciting story because of the, as you mentioned, the young population, the growing middle class there, the rising per capita income that's going to really accelerate, and also being a beneficiary of those companies that want to diversify their manufacturing from China, like Apple adding manufacturing facilities there, and other companies doing the same. So it's a very exciting story, and I plan on holding our stocks there for years to come.
Great answer. Okay, so we touched on this for a minute or in an earlier question, but Alicia, to you, last time I was questioning the U.S. consumer, I think we spoke in September. They've proven to be a little bit more resilient than I would have thought, and Peter articulated that it's a tale of two consumers, the lower-end consumer struggling, and the higher-end consumers going out and buying Hermes and Gucci attire and taking very expensive vacations. Where does the consumer go from here? And if you want to bifurcate your answer between the lower end and the higher end, please do.
So let me just direct your attention to the chart on the left here, which is consumer net worth plotted against the debt service ratio. And the dark blue line is the consumer net worth. It's Fed data. It comes out every quarter. And look at the slope going into COVID. It's sort of a nice 45 degrees. And then you sort of have like an asymptote afterwards. And essentially, household net worth, consumer net worth rose 40% during COVID. At the same time, and that's all the assets, that's because the financial assets, so stocks, bonds, real estate, right? The value of everything moved higher. And plot that against the debt service ratio. So the debt service ratio at the end of 2023 was 9.8% for the consumer. And that's exactly what it was 4 years ago at the end of 2019. So, net worth rose 40%, debt service ratio stayed flat. And that's what's driving the consumption. Add that the labor market, and add that essentially companies have not resorted to mass layoffs here. I mean, we're seeing more layoffs in finance and in tech, but it's not been enormous yet. And so you just have consumers that feel wealthier, their assets are worth more, and they've gotten pay raises over the last couple of years. On top of that, they're getting 5 and 5.5% on their cash, which they didn't before. So overall, it's a pretty good picture. The bottom quintile is struggling. They're living on credit. And so that should be a problem. But the issue is, if you look at it in the aggregate, it's not big enough to affect overall. It will affect spending and consumption on the margin. There's some evidence that the higher end is starting to protest some of the prices and pull back. But again, I just think that the amount of wealth that's been created in the last few years can power this through.
Okay.
But it's a huge
Peter?
surprise. Huge surprise.
Yeah.
Because, the rate cycle is supposed to stop credit, it's supposed to stop spending, and it hasn't.
Peter, I know you wanted to talk about the savings rate chart. So what do you think about what's going on with the consumer?
Well, I with the net worth, part of it, a large part of it is because home prices keep going up. So all these aggressive rate increases, because of the imbalance between those that have a low mortgage relative to current mortgage rates, that home prices keep going up is helping that net worth chart. And why also stock prices being high is a big influence too. So the level of stock prices can itself determine where the economy goes and where consumer spending goes. I mean, you can be sure if the S&P, for whatever reason, goes to 3,000, consumer spending is going to be in a recession. Now, in terms of actual flow of income and spending, this chart shows you that particularly the low and middle income consumer is drawing down on their savings, and they're using their credit card more often and paying a 23% interest rate on unpaid balances. So you just wonder, while the unemployment rate is still low, consumers still feel stretched from. Now, when a consumer goes to the supermarket, they're not thinking, okay, well, the rate of change on egg prices are slowing, so I feel good. No, they're comparing the rate, they're comparing the level of egg prices relative to 3 or 4 years ago, and the cost of living is up about 20% over the past couple of years. So that's what they're stressed out about. And now you have a slowdown in the pace of hirings. So that is something that we have to keep our eye on. That could lead to a rise in the unemployment rate, in addition to consumers spending down their savings, as you can see in this chart. So all things that we have to keep an eye on. Now, one of the reasons why the consumer is still relatively healthy is that they've termed out their debt in terms of a long-term mortgage rate, whereas it's really the corporate sector that has to deal with a lot of refinancing over the next couple of years.
Some good points, I will say. I went to the grocery store the other day and I bought a dozen organic eggs for $8.99 from from Whole Foods, which we could talk about egg prices going down. $8.99 for a dozen eggs seems a little offensive to me. Okay, we got some questions from the audience here. Mark Baum, thoughts about which emerging markets will perform the best? I know, Peter, you talked about India. Do you have any other thoughts about which emerging markets you like?
I also like Vietnam. I like Singapore. Mexico has done very well as a beneficiary of the reshoring. Brazil is interesting, and Argentina potentially is one of the most exciting emerging countries out there with the new libertarian president.
Alicia, anything to add to that?
No, same list, really. Vietnam, we love Mexico, reshoring, friendshoring, Brazil, and Argentina is very interesting, as well as India. The way we invest in emerging markets is really just to choose managers who just avoid China. We just think it's a difficult market for U.S. investors to get their money out.
Is there good ETFs that you guys recommend? How does one express a view on these countries that you made in Mexico? Is there an ETF you like, Peter?
Well, yeah, you can buy some of these country ETFs, but there's some individual companies that benefit, sort of called from the growth of Asia. Like AIA Group, which is one of the largest insurance companies in Asia, so benefiting from the rising middle class in a lot of these different countries.
Okay. All right. Another question, Mark Smith. What are some favorite relative value investment ideas based upon these viewpoints? Public equities versus private credit versus private equity, international versus U.S. Alicia, you want to start, and then we'll go over to Peter?
Yeah, so I still like the U.S. over international. There's always the valuation, argument made for international, but in the end, you don't get the same multiples overseas as you do here, primarily because the innovation in the tech sector is here, and that's what drives the multiple here. We think the dollar actually remains strong this year. There was a call for a weaker dollar. I think that's going to be a bit of a struggle here because the U.S. economy is likely to outperform rest of world. So stronger dollar, and with that, U.S. assets. I think you start nibbling on mid cap here. It's just underperformed. If the economy remains in place good enough, those companies should do fairly well. Again, small cap, if you buy on the index level, you're really exposed to small and medium-sized banks, and so that's a problem.
Okay, so to do that, do you buy the Russell and short a bank, a regional bank index, or how do you best do that?
So you can short the KRB or the KRE and buy the Russell to hedge out your risk. I mean, in the end, the Russell really is 20% below its high. The valuation is extreme compared to the S&P. Doesn't mean you do it today, but I think that's ultimately the right trade for the year.
Okay, Peter.
I think emerging markets are compelling. I mean, we had the most aggressive rate hiking cycle for 40 years, and not one emerging market blew up. When has that ever happened? Emerging markets seem to always blow up when the central bank raises interest rates here in the US. And that tells me that the emerging market story is on much firmer footing than at any time we've seen in many, many decades. And my contrarian call going into this year, and it's been wrong so far, is that the Hang Seng is actually going to outperform the S&P 500 this year. The valuation discrepancy is so extreme. The Hang Seng is trading at 7 times earnings with a dividend yield near 5%. And all you need is some level of stabilization. All you need is something to be less bad over there. And you're going to get quite an outperformance, I believe, relative to the S&P, which, as we said earlier, is dominated by a few stocks that everyone is in love with. And so I think emerging markets are actually compelling. And in particular, on the debt side, I think sovereign local currency emerging market bonds are actually a very interesting place to be and have well outperformed U.S. Treasuries over the past couple of years.
Interesting. So, and also Market asked about private credit, for public versus private credit. I mean, private credit is kind of like the hottest new thing over the last couple of years. Billions and billions and billions has been raised in private credit as bank lending has pulled back. And I think it's an interesting space. I do say when too much money chases something, you start getting lower yields, worse structures. Obviously, if there's a lot more competition for a loan, instead of doing it 15%, somebody's going to do it 11%. They're going to throw out this covenant or that covenant. So I am a little worried about the deterioration in credit quality with all the money chasing private credit. And a little side note is I do my own deals. I do a lot of hard money lending deals, and I write about it in my newsletter. And I've had a number of large hedge funds reach out to me direct and say, well, you're doing these deals. If you have anything, show it to us. And this is Eric Rosen doing this by himself. There's no team. That's just me who does it. So the fact that some pretty major hedge funds are contacting me looking for flow tells you that it's getting a little bit competitive on the private credit side. But I do think hard money lending, you could still get some pretty good rates. So with that, I want to thank everybody for listening. Great questions from the audience. Peter and Alicia it's always a pleasure to be with you. I really thank you for being here. And it's always informative. I always learn something. One last point. I touched on the power of the 3i network when I started, and I'm in John Brecker's office right now doing this so I could have dinner in Miami at Milo's tonight. But I would say take advantage of this network. Go out of your way, reach out to somebody on Slack, reach out to somebody on email, or give them a call, make a new contact. I can tell you that I think I have one of the best networks I've ever met in my life. I'm one phone call away from basically anyone in the world. I constantly meet new people and make new connections through 3i because I aggressively do it myself. So don't wait for the phone to ring. Pick up the phone and call one person a week. Send them a text, send them an email, send them a Slack, and just have a 10-minute conversation. And you'd be surprised about what you can do. I'm working on a transaction right now with another member. We're looking at a deal together that I brought him. He's an expert on something that I'm not. And so that's what you got to do. You got to go out and reach out and make the network work better for you if you can do that. So thanks for listening. Thanks for following. I always end all these things with the Rosen Report hat. So thank you. Have a great night. Alicia and Peter, thank you for being with us. Appreciate it.
Thank you.
Bye-bye.
Thanks, everybody.